Hello everyone, welcome back. Today we are going to dive deep into the economic benefits of derivatives. We have already talked about risk management in detail in previous videos. Now let's explore other important aspects that make derivatives valuable in the world of finance. Derivatives can catalyze entrepreneurial activity. By providing businesses with the ability to hedge risks, entrepreneurs can invest in new projects with more confidence. For example, a startup that relies on imported materials can use currency futures to lock in exchange rates. This reduces uncertainty, allowing them to focus on growth and innovation instead of worrying about fluctuating costs. Ultimately, derivatives encourage more businesses to take calculated risk and drive economic growth. Moreover, derivatives provide valuable signals of market movements and aid in price discovery. When traders engage in derivative transactions, they reflect their expectations of future prices. For example, if many traders are buying oil futures, it signals that they expect oil prices to rise. This information helps other market participants make informed decisions. It's like having a glimpse into the market's collective mindset. Let me give you another example. Let's say there is a surge in call option activity for a tech company like Infosys before its quarterly earnings release. This indicates that traders believe the company will report strong results, which can influence other investors' decision. Derivatives improve market efficiency. The more participants there are in the market, the more information is available. This leads to better price formation, which means that prices reflect the true value of the underlying assets more accurately. Efficient markets are vital for economic stability as they help allocate resources more effectively. Accurate pricing ensures that capital flows to its most productive uses. For instance, if a company's stock is undervalued due to lack of information, it may not attract enough investment. However, with a well functioning derivatives market, the information is disseminated rapidly, prompting investors to act and drive the price to a level that accurately reflects its worth. Another key benefit is that derivatives enhance the liquidity of the underlying assets. Liquidity refers to how easily an asset can be bought or sold in the market without causing a significant change in its price. High liquidity means that there are many buyers and sellers for an asset, making transactions smoother and quicker. In contrast, low liquidity can lead to price instability, making it challenging for investors to enter or exit positions without impacting the asset's price. When derivatives are traded, they increase the number of market participants, making it easier for investors to buy or sell the underlying asset without significantly impacting its price. This increased liquidity is beneficial for everyone involved, as it allows for more efficient trading and better price stability. Derivatives market often involve market makers who provide liquidity by facilitating traders. They continuously buy and sell derivatives to ensure that there are always available orders in the market. Example, market makers in options may take on both sides of a trade, buying and selling, to maintain an orderly market. Their activities ensure that there are a constant flow of trades, which supports liquidity in both the options market and the underlying market. This function is crucial for maintaining smooth market operations. Derivatives also help stabilize volatility in the market. When traders use options to hedge against potential losses, it reduces the impact of sudden price movements on the underlying assets. For instance, a company's stock may experience sharp fluctuations due to market rumors or earnings reports. If investors hold put options, which increases in value as the stock price falls, they can offset their losses on the stock. This protective mechanism helps cushion the impact of volatility, leading to a more stable market environment. Derivatives can help reduce transaction costs for investors by allowing them to gain exposure to an asset without having to buy or sell the actual underlying asset. This is especially beneficial for the large institutional investors who may face significant costs when trading large volumes of stocks. Example, consider a fund manager who wants to increase exposure to oil prices without purchasing physical oil or oil stocks. Buying a large number of oil shares could lead to high transaction costs due to the large volume of shares being traded, plus potential market impact costs. Instead, the fund manager can trade oil futures contract. By buying futures, the manager can gain the same exposure to oil prices without the need to physically buy oil and execute large stock trades. The transaction costs associated with trading futures are typically lower than those for trading physical assets, especially in large volumes. For instance, if the transaction cost for the buying physical oil is 1 lakh, for a large volume, the fund manager may only incur 10,000 in transaction costs when trading oil futures. This cost efficiency allows a manager to allocate more capital to the underlying investment, improving overall portfolio returns. So, derivatives can also enhance portfolio management by providing a tool for hedging risks and improving asset allocation strategies. Investors can use derivatives to protect their portfolios from adverse price movements, allowing them to maintain a balanced risk reward profile. Example, imagine an investor holds a diversified portfolio of stocks, including technology companies and consumer goods. However, they are concerned about the potential downturns in the tech sector due to anticipated market volatility. To manage this risk, the investor can use index options on a technology index, such as the Nifty IT index. So, by purchasing put options, which gives a right to sell the index at a predetermined price, the investor can hedge against potential losses. If the tech sector declines, the gains from the put option can offset losses in the stock portfolio, thereby stabilizing the overall portfolio value. This strategy allows the investors to stay invested in the tech sector while protecting against significant downturns, leading to better risk management and portfolio performance. So, to sum it all up, we have covered some really important economic benefits of derivatives in the financial markets. Firstly, derivatives are great for managing risk. They allow businesses and investors to protect themselves against uncertainties, encouraging entrepreneurial activity and growth. Secondly, they provide valuable insights into market movements. For instance, increased activity in options can signal expectations about the company's performance, helping investors make informed decisions. Derivatives also improve market efficiency. More participants in the market lead to better price formation, ensuring that asset prices reflect their true value. Additionally, they enhance liquidity, making it easier for investors to buy and sell without causing significant price changes. Moreover, derivatives can lower transaction costs. Investors can gain exposure to assets without needing to buy or sell the actual underlying asset, which can save money, especially for large traders. Finally, derivatives help with portfolio management by offering ways to hedge risks and optimize asset allocation strategies. In summary, while derivatives may seem complex, they offer crucial benefits for risk management, market efficiency, and investment strategies. So that's all for this video. Thank you and see you in another one.